Altcoins are flashing a signal so rare. It's only appeared 3 times in the past 8 years. And each time it marked the beginning of an altcoin supercycle. 2017, 2021, and now. The alt season index has fallen below even post FTX levels, a reading lower than the crash itself. So superficially, it looks like apathy, perhaps, if you don't understand the signals and connect the dots. However, underneath this masked sense of apathy, it's the moment that usually triggers the next flood of liquidity. If you've been around, you would know every cycle starts in silence, then something shifts, and this time, that shift has begun the moment gold lost 3.37 trillion in market value in a single week, which is the same as the total combined value, listen to this carefully, of Bitcoin, Ethereum, Binance Coin, Solana, and XRP for perspective. And as I've said in recent past videos, that capital is already looking for a new home. So by the end of today's video, you'll see how the biggest capital migration of the decade from gold and tech into Bitcoin, Ethereum, and the altcoin market has already started. So let's get into it. And let's start by taking a look at the macro conditions. Right now, we see the global liquidity switch has flipped, and traders now expect 3 rate cuts this year. 75 basis points of easing already priced in, and history shows what follows. Every time the Fed cuts with markets near an all-time high, prices rise over the next year, and it has happened 21 times in a row. Now, that same setup is merging with seasonal strength. The post-election year pattern shows the S&P 500 rally from late October into year end. And when the market is up more than 15% heading into November, the final 2 months finish higher in out of 21 cases. Liquidity is loosening just as seasonality is turning positive, which together form the perfect tailwind for risk assets. Even derivative traders are confirming the shift. The put to call ratio, which tracks how many traders are betting on declines versus gains, just dropped 0.62, its lowest level since 2020. And a low reading means investors are buying more calls than puts, signaling growing confidence and a return to speculation. And at the policy level, momentum is building too. Trump has said he will replace Jerome Powell within months and has already secured a $550 billion Japanese investment deal with Prime Minister Takachi. Liquidity, policy, and politics are all pulling in the same direction. Meanwhile, capital concentration is reaching extremes. Apple and Microsoft both crossed 4 trillion in market cap this week, a sign that the largest pools of wealth are running out of room at the top. And when money becomes this crowded, it looks for the next open lane, and the fastest growing frontier now sits in digital assets. Now let's lean into this conversation of capital migration a little more, because gold has just lost more value in 1 week than the entire crypto market is worth. Its RSI has fallen from a record overbought zone back to neutral, signaling that investors are beginning to move out of a defensive mode and back into risk. And that pullback sets the stage for a familiar pattern. In 2020, gold peaked near $2,100, and almost immediately Bitcoin launched from $10,000 to $50,000. And Fundstrat's latest model shows gold topping again around 4,300 this month, a setup that often precedes a Bitcoin breakout. And on-chain data supports the timing as well. Whales are back in profit above 112,000, reclaiming control of the market and positioning themselves for expansion, because that's what they believe is going to happen. So together, falling yields and record money market outflows and a cooling gold chart tells the same story. Capital is rotating away from traditional stores of value and into digital assets that are ready to absorb the next wave of liquidity. So while retail attention drifts elsewhere, and you can't blame them because they're just uneducated, which is why we need to bring them here to my channel, because I attempt to break things down in a way that is easy to follow. Anyway, as their attention drifts elsewhere, the largest players in the world are quietly accumulating. Bitcoin ETFs brought in 149 million in net inflows last week, and Ethereum ETFs added another 134 million, a clear sign that institutional capital is stepping back. And ARK Invest has joined the momentum as well with $76 million in a Bitcoin purchase. And across the Pacific, Hong Kong has now approved new ETFs for Solana, Litecoin, and HBAR, expanding regional access to digital assets. And at the same time, Bitwise and Grayscale are broadening their global lineup, reinforcing how fast the institutional framework for crypto is spreading worldwide. And that same shift is happening at the sovereign level. Eric Trump confirmed that the UAE and several other countries are now actively buying Bitcoin, while his father's administration pushes a pro-crypto agenda, including a new prediction market under Trump media. And traditional finance isn't standing still either. Bitwise reports that nearly every major bank, we're talking about JP Morgan, Citibank, Deutsche Bank, Fidelity, and UBS, now run some form of crypto operation, whether it's trading, custody, or tokenization. And as Matt Hugan explained, markets continue to underestimate what's coming. And I hope that's not you, because right now, with the sovereign adoption we're seeing, regulatory clarity that we're seeing, and into this next new year, plus tokenization growth and a global return to the debasement trade, it's very clear to see this rotation is no longer a theory, it's no longer speculation or wishful thinking. It's being executed in real time. And those that are not plugged in, they are missing it. They're going to miss the boat. Because across balance sheets and trading floors and government policy, we are seeing this adoption everywhere. That said, now let us shift gears and focus on the following narratives. Let's take a look at what's going on with the supply squeeze. What are the drivers? AI and Ethereum. Right now, Ethereum is emerging as the corporate treasury play of this cycle. Companies now hold 24.97 billion in ETH. Let that sink in. It's about 5% of the total supply, and that share continues to grow. Bitmine, led by Tom Lee, is driving much of this accumulation. The firm now controls roughly 9.4 billion in Ethereum, or 2.8% of the total supply. And he has outlined plans to scale its position towards 5% ownership by 2026, next year. And in a single day, Bitmine added another $320 million, underscoring how aggressively institutional buyers are locking up supply just as market demand begins to soar and recover. And that tightening supply is meeting a bullish technical backdrop. Ethereum's chart now mirrors its 2021 breakout, a compressed wedge forming around prior highs, near 4,200. A decisive break above that level would likely trigger capital rotation into mid-cap and emerging assets, extending momentum across the entire altcoin sector. So overlaying all of this powerful macro narrative, the open AI PayPal partnership, which embeds payments directly into ChatGPT, which signals the merging and emergence of artificial intelligence coupled with digital finance. And as AI adoption accelerates, crypto is becoming the underlying infrastructure for how value moves. Two technological revolutions converging on the same rails, having a baby. And if we take a look at technical indicators and sentiment, on-chain metrics have flipped green for the first time since early October. The Bitcoin Bull Bear Structure Index and Unified Sentiment Index have both turned positive, showing that market psychology and blockchain data are finally moving in sync. It's the first clear signal that confidence is returning beneath the surface is that this quiet optimism hasn't yet reached traders. Bitcoin demand from speculators remains at year-to-date lows, a pattern that historically marks the final stretch of accumulation before major price acceleration. So this is the calm that usually comes right before the market wakes up and starts to move. And whales are already positioning for it. They're back in profit, retail participation is climbing, and Asia is leading daily Bitcoin gains. The setup mirrors mid-2020. Calm order books, steady accumulation, and a massive short wall overhead. More than $5 billion in shorts sit between $115,000 and $118,000 waiting to be liquidated. Hopefully that's not you, because once that ceiling breaks, the move could cascade quickly. Seasonality adds fuel to the setup too. November and December we know have been Bitcoin's strongest stretch historically, with 8 of the last 12 Novembers closing green with an average gain of 46%. And now retail is starting to wake up. Individual traders account for 22% of all US stock market activity, double the pre-2020 average. And Google searches for altcoins season are surging again, which is a key indicator we always look for. So together, these signals paint one picture. The ignition phase is here. It's the same combination of disbelief, buildup, and breakout that has marked the start of every Bitcoin supercycle, which I believe is still coming. So as we wrap up today's video, I hope you see the data tells us a very clear story. Gold is cracked, the Fed has turned, sovereigns are accumulating, corporates are locking up supply, and altcoins are flashing their rarest signal in decades. Every major capital flow in the world is now migrating toward digital assets. From 3 trillion leaving gold to billions flowing into ETFs and AI merging with payments, this is how every historic cycle begins. Quiet, coordinated, and then unstoppable. We are watching liquidity rotate in real time, from walls to networks from old systems to programmable money. This is the ignition phase of the Great Rotation 2.0. That's it for today. I love you guys so much. Please subscribe if you haven't and share this video with someone who needs to know what's up. I'll catch you guys here tomorrow.